The Financial Planner, presented by BSC, Investors Protection Fund.
Hello and welcome. You're watching Financial Planner. Now, the next 30 minutes, we're going to talk about mutual funds. To talk about that, we've got with us Hemant Rustagi of Wiseinvest joining us in our Mumbai studios. Thanks, Hemant, for joining in this evening. Hemant, to begin with, I mean, you've pretty much laid this down on a red carpet for me, but I'm just going to start talking about mutual funds and why asset allocation is so important to financial planning.
I think asset allocation is very, very important as a process while investing in mutual fund. Before you start investing in a mutual fund, it's very important for an investor to know exactly how much money has to be invested in different asset classes, whether it's equity, whether it's debt, whether it's gold. And this is what exactly an asset allocation does. The mistake investors make while investing in mutual fund is that they straight away jump onto the last step, that is to decide on which fund to invest in. So as a result, their asset allocation goes for a toss. Either they end up having a very aggressive portfolio or they end up having a very conservative portfolio. So I think it's very, very important that investors should follow asset allocation process. It's also important from the investor point of view because it helps investor in knowing what kind of risk he's taking on his portfolio and also what to expect in terms of returns. The second important thing for asset allocation is that once you decide the asset allocation, within that asset, it's very important to have a diversified portfolio. I think that is where a mutual fund have an important role to play, because we know that mutual fund is a diversified investment vehicle. So even if somebody is investing 5,000 rupees, you can actually invest in a portfolio of 40 to 50 stocks spread over different sectors and different segments. Similarly, when you invest in a debt fund, then you look at public sector debt, private sector debt, money market instruments, and government securities. So mutual fund is a vehicle which allows investors to have diversification within the asset class. But it's equally important to also follow the right process for deciding your asset allocation. So there are a couple of factors which investors need to really focus on. One is the time horizon, and second is obviously the risk tolerance. Time horizon is very important, and the reason for that is when we invest for the short term, the risk is of losing capital. So which means that you should invest in an asset class where you don't lose capital, the capital is safe, at the same time you get decent return. That's where the focus has to be on debt. When you invest for the long term, the risk is of inflation. You need to beat inflation. So that's where you start investing in equities. So I think this is the way exactly how investors should be following the process for investing in mutual funds.
Hemant, you mentioned risk, and I think that's one of the most crucial aspects of financial planning or investing, because nobody at the face of it would be willing to take risks. So most of us are very risk averse by nature, and Indians especially are. How is mutual fund plays out in terms of your risk profile? So how important is risk tolerance? Because nobody really likes to lose money.
Oh, yes, you're absolutely right. All of us want to make the maximum return without taking any risk on the portfolio. I think risk tolerance is very, very important. And there are two kinds of risks that you, as an investor, you face when you invest in mutual funds.
So there's always risk involved, if you're a short-term investor or a long-term investor.
Oh, absolutely.
So you've got to have some amount of risk-taking appetite.
Oh, absolutely. This is what investors need to understand.
Right.
As I mentioned, there are two types of risk that investor takes. One is the financial risk. So that is broadly, tackled by asset allocation. Asset allocation gives you diversification, which means your part of your portfolio is invested in different asset classes. So that financial risk is taken care of by the asset allocation. The second risk is the emotional risk. This is again very, very important for an investor. That happens generally when you are not fully conversant with an asset class. For example, when we talk about equities in an asset class, we know it's a proven fact that over the longer term it gives you the best return.
Right.
But the fact is that it also has a tendency of being volatile during short term and medium term.
When you say long term, how long is long term? Because those definitions have changed with the way the economy has been looking now.
But I think it's more to do with your own time horizon.
Okay.
The thing is, there is no hard and fast rule which says 3 years are long and 5 years are long. The point is, if I'm investing for my retirement for the next 15 years, for me that is long term.
So if you are risk averse, what is the kind of portfolio? So what would be an ideal portfolio for somebody who's risk averse?
That's what exactly, as you said earlier, there is risk in everything.
Right.
For example, even when you invest in a debt portfolio.
Or even fixed deposits for that.
Oh, absolutely. There is a risk. All of us think that when you invest money in the bank, it's fully safe. No, it's not.
That much security.
It's not. Even when you're investing in a debt fund, you must understand that as an investor, you have to face the volatility risk on account of interest rate movements, right? So there are different kind of debt products that do well in different kind of scenarios. So if the interest rate is rising, then you have fixed maturity plan doing very well. When the interest rates are going down, then you have short term or the debt fund doing very well. So I think every kind of investment that you do, I think that is why it's very important for investors to put risk in proper perspective. understand. Like, when we talk about risk, we always talk about risk of losing capital. We never consider inflation as a risk. I believe inflation is a bigger risk than capital loss. If I'm investing for a longer term, okay, there are hardly any chances that I'm going to lose my money. But I need to invest to be able to beat inflation. And that is what I think investors need to look at.
Right. What about, Hemant, what about over-diversification? Because you do say that that's one of the most commonly faced worries or issues by investors, and I'm guessing this is across the board. How does one rectify that? What do you define as over-diversification anyway?
Well, over-diversification mainly happens because many investors do not follow the right process, What typically happens is that investors will invest in every fund that comes their way, which means that suddenly they realize they have 20, 25, 30 funds in the portfolio. And the second is, on the other side, you have investors who believe that to have the right kind of diversification in the portfolio, they need to have so many funds, which is not the right way. Suppose somebody has 20, 25 funds in the portfolio, and they're all the similar kind. Suppose they are investing in equity funds, and they're all investing in large cap or mid cap, the similar kind of fund, following similar kind of strategy or philosophy. On the other hand, if you have a portfolio of 5 or 6 funds, wherein they're investing in different segments of the market, different sectors, following different investment philosophies, a portfolio of 5 funds would have more diversification as compared to a portfolio which has maybe 25 or 30 funds in the portfolio. So I think it's very important to look at diversification from the point of view of whether one is able to invest in different segments in different parts of the market or not. If one realizes that there are too many funds in the portfolio, I think one way to tackle that is to first weed out the non-performing fund. When you have so many funds, it's quite likely that you have a lot of non-performing funds, and you also have some of the best performing fund. But the fact remains that if you do not have the right kind of allocation to the best performing fund or top performing fund or funds which have been doing very well, then the portfolio is not giving you the kind of return you are expecting it. So you need to weed out the non-performing fund. Second is, it happens many times when the markets are doing very well, we start investing in what we call the flavor of the month kind of funds, which means that we make our portfolio very aggressive, which often takes us beyond our risk-taking capacity. So I think at times like this, when one is trying to reduce the number of funds, we need to identify those aggressive funds, make sure that that money is pulled out from there, and these are typically like opportunity funds or mid-cap funds or sector funds, and reinvest that money into well-diversified funds. So what it will do is it will create the right balance in the portfolio and also ensure that the portfolio performs more consistently.
Right. Hemant, also, at least recently in the last couple of years, you've seen that flows coming into mutual funds have actually eased off quite sharply because people have become so risk-averse. With the way the equity market's moving, some call it a bear market trend, some say it's a bull market. There's a lot of confusion that's clouding our judgment, if I can say that. How does one determine? I mean, it's great to catch a falling knife, but how often do we catch a falling knife? So what I'm going to get at is, how important is a short-term trend in a market while deciding how much money one should look to invest?
Well, short-term, in fact, definitely would impact investors. But I think investors need to realize that they should not allow these short-term trends to impact their long-term investment process. The thing is that if we don't plan our investment properly, what typically happens is that suddenly you see the market going up, then the money is moved from debt, and a lot of exposure is now taken then in equities. Similarly, when the markets are going down, all of a sudden, entire investment is taken out of the equity as an asset class and then invested in debt. Now, that is where I think investors need to be very careful. They should not allow the short-term trends in the market to have an impact on their portfolio. That is why, as I said earlier in the show, asset allocation is very, very important, because once you follow this process, it ensures that you're invested in different asset classes at all time, and you don't end up taking a very big risk. And as you mentioned, it's always risky to invest in a falling market. There are different kind of reactions that come in a falling market. There are some investors who believe it's a great opportunity. Some investors get scared.
Yeah.
Fear takes over, and then they exit from there. So I think that is why it's very important for every investor to follow the right process as we discussed earlier.
So I guess you shouldn't try to read trends into the market, because that's almost impossible, as savvy as you are to do.
I mean, even the best of fund managers can't
Get
do
it
that.
wrong,
I mean,
exactly.
everyone would like to, buy low and sell high. But believe me, in practice, it's very, very difficult. Even the best of fund managers find it difficult to practice this consistently. So one should avoid doing that.
Right. What about, just moving on from there, you've talked about the fact that one of the trickiest issues faced by investors to handle a rising as well as falling market, which is what I think most of us are struggling with right now. You know, while in a rising market, most investors allow their portfolio to ride on, it's during a falling market that you want to exit, take your, get out of a mutual fund, because obviously your fund is not performing, but your fund can't really perform if the equity markets aren't performing. How does one be patient and hold their horses? Because that's, I think, exactly what they need to do, right?
Well, yes, absolutely. That is why I think it's very important, as we mentioned earlier. I mean, if you define your goals, you define your time horizon. For example, if someone is investing for 10 years, you need to focus on that. Why should, and what is happening in the market, let's say 2 or 3 years from the time when you start investing, impact your decision-making process? The fact is that when you're investing for 10 years, you know that you have that much time horizon to build up your portfolio. In fact, I would say for a long-term investor, the markets like these, the volatile markets, are a great opportunity, provided you're following a disciplined approach and you keep your focus on the long-term goals. So I think volatile markets, in fact, create a lot of opportunities for long-term investor. They shouldn't actually worry so much about what is happening in the market over the short term and long term. So the key is keep your focus on what your plan asks you to do, keep your focus on your goals, keep your focus on your long-term horizon and also the time horizon. I think that will make a significant difference in the way you handle your investment.
Hemant, how do you explain portfolio rebalancing? Because when does an investor know it's a right to exit a given fund? You know, at a time like this when most funds are not performing very well, I know it's all about relative performance, but how much time should you give a fund or your investment enough time to determine whether you stick with it or you don't?
Well, I think portfolio rebalancing is one technique which ensures one thing, that you remain invested in different asset classes at all time. You avoid making decisions, abrupt decisions, what we call looking at the short-term trends in the market. How and when you do it, I think it's a very important question. I believe it should be done once in a year, and the reason why it should be done once in a year is that if you look at the tax benefit for investing in equities or debt, suppose you are investing in an equity mutual fund, after 1 year, any gains that you make is treated as a long-term capital gain, and it's a tax-free capital gain. On the debt side, if you redeem your investment after 1 year, it becomes long-term capital gain, and the tax are paid at the rate of 10% and 20% if you claim indexation. So I think if you do this process after a year, it becomes very, very tax efficient. Second is, in fact, there are certain occasions in life where one has to rebalance the portfolio. So one way is you're doing it on a yearly basis, and what you do is that if you feel that equities have gone from 50 to 70%, you redeem equity, bring it back and reinvest that into debt. In a falling market, if you believe that you started with an equity exposure of 50% and now it has become 30%, then you sell debt and buy equity in a falling market, which it becomes very, very difficult for an investor who does not follow this process. As I mentioned about earlier, there are certain occasions in life where one has to have a close look at one's asset allocation, which is when you're nearing your retirement, or if it is like children marriage. These are occasions which will require you to have a hard look at your asset allocation and see whether it is fit enough or good enough for the current situation that you're in right now.
So in your opinion, Hemant, if none of those situations have come up, how do you determine exiting an investment or selling out of a given fund?
See, this is what exactly portfolio rebalancing does for you. For example, you started with 50% in equity and 50% in debt. Yeah. At the end of the year, you see that equity has come down to 30 because the markets have fallen, and debt has gone to 70. Now, this is the time for you to rebalance. When you rebalance, you exit from debt and you invest that money into equity. Similarly, on the other side, if it has become 70% in equity, as I mentioned earlier, then you redeem that and reinvest that money into debt. So rather than trying to time the market in terms of exiting an entry, you're actually following a disciplined approach, and this is what exactly portfolio rebalancing does for you.
Right. Well, on that note, we'll take a quick break. That was, of course, perspective into asset allocation, how your risk tolerance plays an important role, and how portfolio rebalancing is one of the most crucial aspects of financial planning, and that's probably the only way you could actually create long-term wealth. We'll take a break, we'll come back, and then, of course, take up all your queries with Hemant, so stay tuned.
The Financial Planner, presented by BSC, Investors Protection Fund Firm.
Welcome back. You're watching Financial Plan. It's now time to take up all your financial-related queries.
Investment Ladder, presented by BSC, Investors Protection Fund.
Hemant, we've got a query coming from Dhyandev. He's 30 years old. He's married. He's got one child. His monthly income is about 40,000. He plans to retire at the age of 55. He's got insurance as well, and he's got two queries where he says, first related to his existing LIC policy. He says he's got LIC policy with total about 1 crore 33 lakhs, started in March 2009. After 22 years, every year one of the policies will mature after 21 policies that he holds till the next 20 years. His question, of course, is this a good policy? Should he continue with this policy? Should he switch to term and mutual fund and a PPF plan? Should he stop his LIC plan? And if he should, what's the best way to do it? Should he surrender it or should it be a paid up? In the second one, of course, it's related to his child, and he wants to know what's the best way to plan for the future of his child. He's looking at acquiring about 50 lakhs in about 20 years. What's the best thing to do for him?
Let me begin with insurance. That's because I believe that risk management is a very important part of the financial planning. I think he's done the right thing. He's got a term plan, I think, of 30 lakhs. But if I see his annual income, which is I think 4,80,000, if I apply the thumb rule, basically it comes to around 48 lakhs to 50 lakhs. So he basically requires a cover of 50 lakh. So I think what he needs to do is he needs to take another term plan for 20 lakh, which means that he will have the adequate risk cover. If he does that, and whenever he does that, then I don't see much of a relevance of the other plan, the other insurance plan that he has in the portfolio. He has one endowment plan, one unit-linked insurance plan.
So that's not even
but these are not the plans which will give you the kind of risk cover that you want. At the same time, when you invest your long-term money, especially in the endowment plan, yes, they definitely give you a sure return, but the fact is that they can't even beat inflation. So my point is, once you have covered yourself in terms of risk, life cover adequately, I think you need to really rethink about these two plans. I don't really see them playing a major role. At best, what he can do is, if he has paid the premium for the minimum period, he can let that be there, and he should stop paying the premium, the fresh premium that he has to pay, and that money, a part of that will go into additional premium that he has to pay because he needs a term plan for another 20 lakhs, and the balance can be invested for his long-term goals. Now, what he has done is, on the goal side, he has only defined one of his goals, that is basically for the child's future. I'm sure he's going to have some other goals, like
Hemant, just very quickly, 50 lakhs in 20 years. I mean, I'm not sure whether that's even going to be enough money to keep aside for child's education and marriage. I don't know whether he's taken inflation into account here.
Yeah, that is, as you rightly said, I think that is a very, very important aspect. I think every investor, whosoever is planning investment for the long term, must consider inflation. Otherwise, you're going to have a huge gap in what you need after the time period.
You're looking at 20 years.
Absolutely, absolutely. So I'm hoping that he has. It all depends on the kind of education you want to give it for your children. Right. As far as that goal is concerned, clearly, because there is a time horizon of 20 years, my belief is that he should be looking at options like equity fund, because the key is that, as we mentioned earlier, you need to beat inflation over a period of 20 years. So what he can do is, rather than opting for these typical child plans, which I don't think can give the kind of result an equity portfolio can give, he should look at well-diversified equity funds. If I assume a return of, let's say, around 12% over a period of 20 years, he can get there, and he has to invest 5,500 rupees
per month
to achieve that.
Okay.
Now, I'm recommending two funds for him. Basically, one is a pure large cap fund, that is ICICI Focus Blue Chip. Okay, it's slightly different from a normal large cap fund. It basically has a concentrated portfolio, which means that it will have around 25 stocks. But in terms of diversification across industries, it's very well diversified. So that is one fund. He should invest around 3,500 in that. And I'm recommending one pure mid-cap fund. In fact, this fund has around 10 to 15% also in large cap, which is IDFC Premier Equity. So as a combination, I think he should be able to achieve this target over the next 20 years. But I would like to add, he just mentioned about one of his goals. I'm sure he's going to have other goals in short-term, medium-term, and long-term. He needs to really define those goals, assign a time horizon, set a target, and then start working for that. Because it's very, very important that, especially for the long-term goals, that you start investing early. Because when you start investing early, you actually benefit a lot from power of compounding. And in fact, an asset class like equity gives its best result if you give it time to grow.
On that note, we'll take a quick break. We'll come back and continue taking up your queries, so stay tuned.
The Financial Planner, presented by BSC, Investors Protection Fund.
Welcome back. You're watching Financial Planner. Hemant, we've got a query from Prashant Singh, and he says he's got 8 lakh rupees in cash. He's planning to purchase a car which is worth 10 lakh rupees, and he's got an outstanding home loan of 24 lakhs. He's paying 26,000 rupees per month as EMI. He can afford to pay about 50,000 as EMI for the home and car loan together. He wants to complete both loans in the next 5 years. The rate of interest for the car loan is about 9%, and for the home loan it's 10%. How much should he be paying as a down payment for the car and as part payment for the home loan? What should the EMI for both loans be? Because he's comfortable spending 50,000 rupees per month.
I think there are a few important facts that you mentioned here. One is that he has the capacity to pay 50,000 rupees as EMI, and he has a cash balance of 8 lakh rupees. Is basically what he wants to buy. He wants to buy a car. He already has an existing home loan. So if he wants to buy a car, then my recommendation would be that he can pay a margin money of around 20%, which means it will be roughly around 2 lakh rupees is what he requires for the loan. He's mentioned about the interest rate at 9%, unless he's getting a concession rate from his employer. Otherwise, for a 5-year horizon, I think it's going to be around 12%.
Yeah.
So I think he needs to keep that in mind. And if you take that for a period of 5 years, I think then his EMI is going to be roughly around 18,000 rupees per month.
Okay.
On the home loan front, I think I would like him to remember a couple of very important things. That home loan gives you a lot of tax benefits. Under Section 80C, for example, up to 1 lakh rupees when you repay the principal amount is exempted under Section 80C. In addition to that, up to 1.5 lakh rupees that you pay as interest is also exempted from income tax. So I would like him to consider these factors before deciding how much money has to be repaid for the housing loan. But he has made his intention very clear. He's looking at repaying everything in 5 years' time. So my advice to him would be that for the remaining money, so 6 lakh, he can pay that. He will have a balance of around 17.5 lakh. Obviously, how much the EMI will be depends on the kind of conditions that are put in the agreement. But broadly speaking, if I look at a loan of 17.5 lakh with an interest rate of 10%, I think roughly in a time of 5-year period, I think it should be something around 37,000. So in all, he will have to pay EMI of 55,000. He has said he's comfortable with 50. I'm sure he should. I think he will be able to manage that. And this is how he needs to really plan his repayment.
Investment Ladder, presented by BSC, Investors Protection Fund.
Well, on that note, it's time for us to wrap up Financial Planner. Prashant, hopefully that advice from Hemant has helped you. You've got to sort of decide what you're planning to do, but 55,000 is what you're looking at an outgo if you do want to wrap up both those loans in the next 5-year period of time. 2 lakh rupees as a down payment for your car, 6 lakh rupees can be part payment towards your home loan as well. On that note, we wrap up this edition of Financial Planner. Thanks for watching.
The Financial Planner, presented by BSC, Investors Protection Fund.